Ladies and gentlemen, dear friends of gold, it is with great excitement that I present you the 19th edition of our annual In Gold We Trust report. Over nearly 2 decades, we have chronicled gold's enduring power, and today it stands again at the forefront of global markets, setting all-time highs in virtually every currency for the second consecutive year. For investors, the surge in gold naturally raises the question, is it already too late to invest in gold? This year's In Gold We Trust report is dedicated precisely to this question, and it bears the title, The Big Long. Our answer is that we're still optimistic that gold will continue to appreciate in the years ahead. In our view, gold works both as a safe haven and a profitable investment. We call the profitable side performance gold. But more on that later. Do you remember the brilliant movie The Big Short? A small group of contrarian investors around Michael Burry saw what others missed and they acted. The rest is history. The Big Long is about the same contrarian thinking, focused on the structural shifts transforming the global monetary and geopolitical landscape. In this year's In Gold We Trust report, you'll learn why we believe that gold's upward trend is set to continue, how Trump's economic pivot and Europe's fiscal U-turn reinforce our conviction, and most importantly, why the greatest opportunities lie in what we call performance gold, silver, mining stocks, but also commodities and Bitcoin. We could have called this report bullish on gold for many reasons. Instead, we went with the big long. You will see why after roughly 450 pages of research. So please join me now on a brief journey through the key insights of the In Gold We Trust report 2025. But before diving into this year's insights, we extend our deepest gratitude. Over the past month, over 20 dedicated colleagues on 4 continents have contributed over 20,000 hours of research, analysis, chart making, translation, and design to create our beloved report. So big thanks to my whole team. And equally vital are our premium partners. Our premium partners who enable us to publish the full report free of charge in English and in German, as well as the compact version in Spanish, Mandarin, and for the very first time this year, also in Japanese. Many thanks to our premium partners, the creme de la creme of the industry. Now let us first take a look back. In our In Gold We Trust report 2020, the dawning of a golden decade, we forecasted that the 2020s would become gold's decade. And here we are. Since then, the gold price in US dollar terms has nearly doubled, or put differently, the US dollar has lost almost 50% of its value against gold. In 2024 alone, gold marked 43 new all-time highs and broke through the 3,000 US dollar level. Still, we're convinced that this is far from the end of the road. Gold's momentum over the recent quarters has been historic. In 2024 alone, the gold price gained 27% in US dollars and 35% in euro terms. And in just the first 4 months of 2025, gold has already added 22 more all-time highs, lifting the gold price in US dollar terms up by almost 30% and by more than 17% in euro terms. So the bull market is in full swing, even if it's currently taking a pretty well-deserved breather. Now, according to the Dow theory, bull markets typically have 3 stages. First of all, the accumulation phase, then the public participation phase, and finally, the mania phase, the distribution phase. From our point of view, we're currently in the second phase, in the public participation phase, which is the longest and the most dynamic phase, characterized by broadening investor involvement, rising trading volumes, and a growing media attention. Ladies and gentlemen, gold is no longer a contrarian investment, But still, it seems that more Americans believe that Elvis is alive than own gold. Meanwhile, gold is increasingly viewed as what we call the Ronald Koeman of asset allocation. Defensively reliable and at the same time set with offensive potential. Ronald Koeman, the highest goal-scoring defender in soccer history, exemplifies this dual function. Gold also fulfills both roles. It acts as a defensive cover and opens opportunities on the offensive. Now raise your hand if you remember when bonds actually hedged equity market volatility. That's what we thought. A new market requires a new playbook. While gold's appeal as a safe haven remains undisputed, we see greater upside in what we call performance gold, silver, mining stocks, as well as commodities and also Bitcoin. As outlined last year in the new Gold Playbook, these assets form the 40% alternative allocation in the new 60-40 portfolio. High debt and inflation broke the old rules. Bonds and stocks now move together. By allocating 40% to performance assets, investors gain safety and growth. Now let's take a look at each performance gold asset, starting with the question, when will the sleeping silver giant finally awaken? Now the gold-silver ratio stood at 100 at the end of April, putting it well above the long-term median since 1970 of 62. In the past, similarly extreme levels have been followed by an outperformance of silver. Now, fundamentally, silver is facing a perfect storm. In 2024, demand exceeded supply by almost 150 million ounces, marking the fourth year in a row of supply deficits. In addition, silver has outperformed gold in 6 out of the last 7 bull markets since 1967. But nevertheless, the price performance of the white metal has so far remained below the historical average. If silver finally lives up to its potential as performance gold, this could be a great investment opportunity. Now, ladies and gentlemen, picture a coiled spring. Press it down for years. Now watch what happens when you let go. That's mining stocks today, another compelling segment of the big long. Despite gold hitting multiple new all-time highs, the Gold Bucks Index, the HUY, still trades 40% below its 2011 peak, highlighting the sector's potential. Now, in the first 4 months of 2025, miners have begun to awaken, posting gains of roughly 40%. Yet valuations remain at historically low levels. Compared to the last gold mining bull markets, today's companies operate with greater financial discipline, stronger balance sheets, and a sharper focus on shareholder returns. From our point of view, miners still offer excellent leverage to those seeking amplified gold exposure. Even though they're currently taking a breather and have recently come under pressure due to US tariff policies, commodities form the third pillar of our big long thesis. Now, resources are becoming political weapons, not just trade goods. In a world marked by looming dollar valuation, rising protectionism, fragile supply chains, growing defense spending, and ongoing fiscal stimulus. China's dominance in critical mineral processing increases supply risk. At the same time, rising military tensions are boosting demand for defense-related commodities. And with central banks shifting toward easier monetary policy, we expect commodities to return like the underdog everyone has counted out, particularly after a decade of underinvestment in production capacity. When a world superpower endorses your anarchist money, you know that the game has changed. This year, Bitcoin has emerged as a legitimate strategic reserve asset. With the stroke of a pen, President Trump established a strategic Bitcoin reserve, separating it from other digital assets and acknowledging its unique monetary properties. Bitcoin's evolution into a sovereign-level financial asset supports our free Bitcoin, free gold thesis that we presented last year. However, with a market capitalization only 8% of gold's market cap, it still has huge upside potential from our point of view. If gold hits our base case target of $4,800 by 2030 and Bitcoin reaches 50% of gold's market cap, one Bitcoin would be worth $900,000. So from our point of view, Bitcoin complements gold perfectly in a portfolio context. Gold offers stability, while Bitcoin adds convexity. Now, in addition to analyzing performance gold assets, the Big Long naturally also takes a well-founded look at all other key developments in the gold market, as well as major macro trends. Now, central banks just can't stop buying gold. They know what's coming. With global official sector purchases exceeding 1,000 tons for the third consecutive year in 2024, they've achieved a remarkable hat trick. In US dollar terms, central banks bought gold worth more than 100 billion last year alone. Meanwhile, Europe's fiscal discipline has crumbled, with Germany abandoning its debt brake to finance 900 billion in new spending, triggering the largest single spike in bond yields since 1988. The Swabian housewife seems to be dead. And across the Atlantic, efforts to cut spending, including the Department of Government Efficiency's reforms, have been unable to rein in the US federal deficit so far. In February alone, the federal government ran a 300 billion deficit. Over the past decade, federal spending jumped 93%, while revenues rose only by 58%, effectively doubling the national debt. This could force a complete reset of the world's monetary system, a modern-day Bretton Woods moment aimed at restoring financial stability. Once seen as safe havens, government bonds now look like sinking ships. Gold, it seems, is the new lifeboat. Now, Trump 2.0 means big changes for the dollar. Talk of a Mar-a-Lago Accord has surfaced within his circle, a unilateral framework to tie US security guarantees with economic alignment. Allies would be required to buy long-term US debt in return for military protection and market access. Whereas gold-backed bonds, as proposed by economist Judy Shelton, might serve as an incentive. Non-compliance could trigger tariffs, capital controls, or financial isolation. Ladies and gentlemen, one thing is clear for us. Donald Trump wants and needs a weaker dollar to help US exports. However, managing a controlled US dollar devaluation sounds like asking for warm ice lollies or trying to square a circle. It risks accelerating the very downturn it aims to manage. Now, looking ahead to the second half of this golden decade, our base case remains $4,800 by the end of this decade. Comparisons to previous bull markets suggest that the price could rise significantly higher, potentially reaching up to $8,900 in an inflationary scenario. Yet forecasts alone aren't what matter most. It's the discipline in execution. That's why we encourage you to approach the Big Long as a multi-year strategy to reposition tactically using our proprietary Incrementum active Aurum signal, and to stay the course even during interim corrections. In doing so, you're not just positioning yourself for the next market swing, you're aligning with the generational trend towards real assets and monetary integrity. Ladies and gentlemen, for 19 years, the In Gold We Trust report has been your trusted guide during gold's re-emergence as a monetary anchor. So thank you very much for your incredible support. We've become the world's most downloaded gold study with millions of readers globally. Our premium partners make everything possible. The free report, monthly updates, and all of our research on our webpage. Without them, the big long couldn't reach you at zero cost. Now our big long thesis becomes your opportunity. Download the full 450-page report, get our monthly gold compass, and additional research at ingoldwetrust.report. Are you ready to ride the second half of the golden decade? Your big long journey starts now. It is our privilege to walk alongside you. Thank you very much for listening to us, for reading our report, for engaging with us, and always remember, in gold we trust. Thank you very much.